Hello, welcome to Insignia Investments. My name is Rupratin Dotto and today I'm going to discuss with you the variety of investment instruments available in the market that you can consider for your portfolio. I'm going to rank them from the most risky to the least risky. Let's begin. The first instrument for investment is the bank account. Fixed deposits or recurring deposits. Banking system in India is fairly robust and backed by the government of India and thoroughly regulated. Because of this, you have a decent amount of return on your investment, safety, liquidity, and definitely peace of mind. The only downside is that when inflation starts kicking in, the value of your investment is chewed away. The second least risky instrument for investment that you can consider is that of certificate of deposits or treasury bills. These are backed by the government of India and carry a sufficient rate of return. Their prices usually adjust with changing market scenarios and take care of inflation partially. The downside is that the lock-in period is higher and prices can vary if you withdraw before maturity. And now we start stepping into a little high risk, high return zone. The next instrument of choice that you can consider is that of corporate bonds. Now, the advantage of investing in this market is that there are multinational companies that rate these bonds and they actually tell you, give you a sufficient amount of information to understand what the credit situation is for the company. The lock-in periods are usually higher, but they take care of inflation, and usually if held till maturity, they are a definite way of earning money over the long run. The only downside is that when you invest in bonds, you usually compare them against equities, and in that kind of a scenario, their returns are lower. If you're willing to go for a high risk, high return zone and can undertake sufficient amount of pressure, you should definitely look towards investing in high grade blue chip stocks. Now, these are stocks that will return money to you in the long run, and I have described this in earlier videos as well, that if equities are held for the longer run, they offer the best returns. Usually they're difficult to pick. That's one of the risks that they entail. And secondly, you can lose money in this market because the returns are never guaranteed. The upside is, historically, they have been proven to be the best set of investments to be made in the market. Just like blue chip stock equities, real estate is also a popular choice for investment. They offer great returns and can be compared to the likes of equities, but the only downside is they undertake a lot of political risk, a lot of risk with respect to legislation and changing rules of the government. And finally comes the risk of some land losing value because of various reasons like exploration, mining. If you can take a sufficient amount of risk and have a sufficient capital base, this is usually a place where you should definitely look in. If you're young and you're willing to place bets high, the place you should look into is the small cap market. This market has historically given the best returns over the last 100 years in the equity market, and also has been the most exciting part of the market. Usually, if you're investing in this kind of a scenario, you should look into the fundamentals of the stock, should be definitely versed in understanding market scenarios, the environments in which they exist, and finally, reading the balance sheets, reading the profit and loss statements and making sense out of them. If you can understand all of these things, definitely look towards investing in the small cap market. And with that, we come to the most risky choice of investment that you can make. Derivatives. Warren Buffett has classified them as weapons of mass financial destruction, and yes, they surely can be. Unlike equity or bonds or fixed deposits, they cannot run your entire savings down to a zero. But derivatives, they definitely can wipe your slate clean in one single day. If you do not understand the dynamics of this market and you're not conversant about how the pricing works, how the volatility is used, it's definitely a no-no for you. If you're going to save your entire life savings into a singular fund, definitely do not go for derivatives. If you have some liquid fund, young in age, and you're looking to undertake a little more risk to earn a little more return, devote the amount of time to go through the material. There is plenty of material on derivatives on the web, as well as sufficient number of books in the market. Read them, make sense out of them, develop the strategies, try to backtest the strategies on your own, and then and only then undertake your investments in derivatives. And with that, we come to the end to this video. If you like this video, do give us a thumbs up and share it with your fellow investors. For more information, head over to www.insigniainvestment.wixsite.com/home. See you next time.